Someone is earning 15% on the same assets you're earning 3% on. Same DeFi, same capital, different strategy. I'm Rachel from ChainSense. In the next 8 minutes, I'll show you exactly what yield optimization is and why most people leave money on the table every single day. Yearn, Pendle, Convex. 3 tools, 1 system. Let's go. Yield optimization is the art of squeezing maximum returns from your DeFi positions. Instead of depositing into one protocol and hoping for the best, you use specialized tools that auto-compound, redirect rewards, and even let you trade future yield. In 2026, 3 categories dominate. Yield aggregators like Yearn automate compounding across dozens of strategies. Yield tokenization through Pendle lets you lock in fixed rates or speculate on variable ones, and ve-Tokenomics, the vote escrow system pioneered by Curve that rewards long-term holders with boosted yields. Today, I'll cover how each of these works, the platforms leading each category, a head-to-head comparison of Yearn, Convex, and Pendle, the risks you absolutely need to understand, and my exact portfolio allocation for 2026. Let's get into it. Let's start with the simplest concept. A yield aggregator takes your deposit, spreads it across the best available strategies, and auto-compounds your rewards. You deposit once. The protocol does everything else. Yearn Finance is the gold standard. You deposit USDC into a Yearn vault. Behind the scenes, the vault strategy might rely on Aave, farm CRV rewards on Curve, sell those rewards for more USDC, and redeposit all automatically every few hours. Why does this matter? Compounding frequency. If you compound manually once a month, you earn less than someone compounding every 8 hours. With a $10,000 deposit at an 8% base APR, monthly compounding gives you $10,830 after a year. Compounding every 8 hours yields $10,833. A small difference at 8%, but at 20% APR, the gap widens to over $50 annually. At scale, across millions in TVL, this adds up fast. Yearn V3 vaults are modular. Each vault can run multiple strategies simultaneously, automatically shifting capital to wherever yields are highest. The protocol charges a 2% management fee and 20% performance fee, but only on profits. Current Yearn TVL, around $1.5 billion. Stablecoin vaults yield 6 to 10% APY. Blue chip vaults like ETH and WBTC yield 3 to 6%. The key advantage is that it's passive. Deposit and forget. Pendle does something completely different. It splits any yield-bearing asset into 2 tokens, a principal token, PT, and a yield token, YT. Here's how it works. You have stETH earning 3.5% staking yield. Pendle wraps it, creating 2 tokens. The PT represents your principal. It's redeemable for the underlying asset at maturity. The YT represents all the yield that the asset will generate until maturity. Why split them? Because now you can trade yield separately from principal. If you buy PT at a discount, you're locking in a fixed yield. Buy STETHPT at 0.97 ETH with 6 months to maturity, and you'll receive 1 ETH worth of STETH at expiry. That's a guaranteed 6.2% annualized, regardless of what happens to staking rates. If you buy YT, you're betting that variable yields will be higher than what the market expects. YT is cheap because it expires worthless at maturity. But if yields spike, your YT prints money. This is powerful. For the first time in DeFi, you can get fixed rate returns. Or you can speculate on yield direction with leverage, because YT gives you exposure to yield on the full principal amount for a fraction of the cost. Pendle's TVL has surpassed $5 billion. The most popular markets, stETH, GLP, and various LRT tokens. Maturity dates range from 3 months to 2 years. ve-Tokenomics is the incentive engine behind some of the highest yields in DeFi, and understanding it unlocks a whole layer of optimization most people miss. It started with Curve Finance. CRV is Curve's governance token, but raw CRV is almost useless. The real power comes from locking CRV for up to 4 years to get veCRV, vote escrowed CRV. veCRV holders get 3 things. First, boosted rewards, up to 2.5 times higher CRV emissions on your liquidity. Second, governance votes. You direct where CRV emissions flow through gauge voting. Third, protocol revenue, a share of all trading fees on Curve. This created the Curve Wars. Protocols compete to accumulate veCRV because controlling gauge votes means directing yield to their pools. More yield attracts more liquidity. More liquidity means better trading. It's a flywheel. Enter Convex Finance. Convex solved a problem. Most users don't want to lock CRV for 4 years. So Convex collects CRV from users, locks it permanently as veCRV, and passes the boosted rewards back to depositors, minus a 16% fee on CRV earnings. You deposit your Curve LP tokens into Convex. You earn boosted CRV rewards, CVX tokens, plus trading fees, no locking required. Convex controls over 50% of all veCRV, making it the single most powerful voter in the Curve ecosystem. Current Convex TVL, around $2 billion. Stablecoin pools yield 5 to 12% APY. The combination of Curve plus Convex is one of the most battle-tested yield strategies in DeFi. 2 more concepts you need to master for effective yield optimization: auto-compounding. We touched on this with Yearn, but the math applies everywhere. The formula is simple. The more frequently you compound, the higher your effective APY. At 10% base APR, annual compounding gives you 10%. Daily compounding gives you 10.52%. Every 8 hours gives you 10.55%. The catch: every compound transaction incurs gas fees. On the Ethereum mainnet, that's $5 to $15 per transaction. If your position is $1,000, compounding daily costs more in gas than the extra yield. This is exactly why aggregators like Yearn exist. They socialize gas costs across all depositors. On layer 2s like Arbitrum or Optimism, gas is pennies. Compounding every few hours becomes viable even for smaller positions. This is why L2 yield farming has exploded. Now, impermanent loss. If you provide liquidity to an AMM pool, say ETH/USDC on Uniswap, and ETH's price moves significantly in either direction, you end up with less value than if you'd held both assets. This is impermanent loss. The key insight: impermanent loss is only permanent if you withdraw while prices are diverged. If prices return to your entry ratio, the loss disappears. And trading fees you earn as an LP can offset or exceed the loss. How to minimize it? Use concentrated liquidity ranges on Uniswap Yearn V3. Tighter ranges earn more fees but have higher IL risk. Use correlated pairs such as ST/ETH, where price divergence is minimal. Or use Curve's stable swap pools designed specifically for similar value assets. So, which platform should you use? Let me compare them directly. Yearn is the passive option. Deposit and forget. Best for stablecoins and blue-chip assets. Yields of 3 to 10% APY. Lowest complexity, lowest risk. The trade-off? Fees eat into returns, and you have no control over strategy selection. Convex is the boosted option. Higher yields than vanilla Curve, 5 to 12% on stablecoins. You need to understand Curve pools and gauge mechanics. Medium complexity. The risk: exposure to CRV and CVX token prices. If CRV dumps, your boosted rewards are worth less. Pendle is the strategic option. Fixed yields through PT, currently 6 to 12% on popular assets. Variable yield speculation through YT. Highest complexity: you need to understand maturity dates, implied rates, and token mechanics. But the payoff is the ability to lock in rates no other platform can offer. My ranking for beginners: Yearn first. Learn how vaults work. Then Convex for higher yields. Then Pendle once you understand yield curves and fixed income concepts. Every yield strategy carries risk. Here's what to watch. Smart contract risk. Every protocol runs on code. Yearn has been live since 2020 with billions processed, battle-tested. Convex and Pendle are newer but have passed multiple audits. Still, no protocol is 100% safe. Token price risk. Rewards paid in CRV, CVX, or Pendle can drop in value. Your 12% APY becomes 6% if the reward token halves. Always factor in token price volatility. Liquidity risk. Pendle PT tokens can be illiquid near maturity. Yearn Vault withdrawals can be delayed if strategies are fully deployed. Always check withdrawal conditions before depositing. Impermanent loss. We covered this. It applies to any AMM-based strategy. My rules: never put more than 30% in any single protocol. Start with stablecoins before volatile assets. Use only audited, battle-tested platforms. And monitor your positions weekly. Yields change, and so should your allocations. Here's exactly how I'd allocate $10,000 for yield optimization today. 50% into Yearn stablecoin vaults. USDC and DAI vaults are yielding 6 to 8% APY. This is the foundation. Low risk, fully automated, battle tested. $5,000 working passively. 30% into Pendle PT positions. Lock in fixed yields of 8 to 10% on STETH and GLP principal tokens. $3,000 with guaranteed returns at maturity. No variable rate risk. 20% into Convex stablecoin pools. Boosted curve rewards yielding 8 to 12% APY. $2,000 earning enhanced yields through ve-Tokenomics. Slightly higher complexity, but significantly higher returns than vanilla curve. Expected blended yield, approximately 7.5 to 9% annually. 3 platforms, 3 different yield mechanisms, diversified across smart contract risk, token exposure, and strategy type. What I would not do: chase 50% APY farms with unknown tokens. Concentrate everything in one protocol. Ignore impermanent loss on volatile pairs, or skip weekly monitoring. That's yield optimization in 2026. 3 powerful strategies: aggregators, tokenized yield, and ve-Tokenomics, each with different risk-reward profiles. If you found this helpful, subscribe to ChainSense for more honest DeFi education every week. Check out my website for the complete written guide. It covers everything we discussed today, plus step-by-step tutorials, detailed platform reviews, and comparison tables you can bookmark. Drop a comment. Which strategy are you going to try first? Yearn vaults, Pendle fixed yield, or Convex boosted rewards? I read every single one. Not financial advice. Digital assets carry risks. Always do your own research. See you in the next video.